Now let's jump into some examples. And again, we're going to use the same example we've been using for the past two videos here on US dollar, Japanese yen, just building on the zones that we've already mapped out and really just going through the way price action is returning back to the zones just to further explain what we've just been building on. So what we'll do is we'll start on this very first demand zone, this range created demand zone or the pivot created demand zone. As we can see, we had that large move to the upside, and if we don't worry about too much about all the zones that were created as this zone was coming back into it, what we can see is price was very corrective as it made its way back. And touching on what I spoke about in the end of the previous video, the theory behind the return to zone, we have this more impulsive move into the zone. As well as here, as we can see, we have two impulsive drives into the zone, but leading up to the zone itself was quite corrective. And what we can see is, even if we look at this point in time where price was about to tap into it, we can see that we had fairly corrective moves back in to the zone. We didn't actually tap into the zone, and then we were seen with quite a bit of momentum pushing to the upside, which shows that this zone was fairly powerful. But definitely what we can see from the reaction and when we move the chart to the right, although we're not really focusing on what's actually happening as a result of these zones, just to add on to that, you can see that price tapped into the vicinity of the demand zone, and then once we actually tapped into it, it didn't quite move as far as we had expected. But now what we can do is we'll move on to this next demand zone, this range created demand, or specifically the pivot demand that we were looking at. We had that large move to the upside, and then what we can see is price just immediately came right back down. So we had the expansion up and an expansion down back into the zone. And what I said in the previous videos is, more often than not, we do get a reaction for basically every supply and demand zone that we see on a chart, whether the reaction is on the time frame that we are currently on or if it's on just, say, a lower time frame. There's, generally speaking, always some sort of reaction. But at the end of the day, what we're most concerned about is the follow through of that zone. That's where we're actually going to be able to take successful trades, because it goes without saying, if we were to have entered long within this demand zone, initially we would have had a small amount of profit, but the end result of the trade would have been a loss or a break even, depending on how you manage it. So it goes without saying that we're more concerned about the follow through when it comes to supply and demand zones, and we want to build the highest probability and the highest cases for entries. And we know that, generally speaking, when we have these V-shaped returns, it's an aggressive reversal from a creation of a zone, and generally speaking, the odds of that zone playing out or following through become to be a little bit more diminished. So we'll move on, and as we see, we create this supply zone, which we'll talk about now, where we get a more corrective move back into it, and then we tap into the zone and then continue on to the downside. And what we can see is we had a fairly aggressive move into the zone, which gave us that more confirmed and larger push away. You can see that we had a decent wave out of the supply zone in question. We did get this small push too, and if we see that we did have a somewhat large move into it and we had an aggressive push away from the supply zone. Now what we can see, if we just looked at the return from the left side of the chart, we can see that this is more of a V-shaped reversal. We had a little bit of correction, move back in, but I think we can all agree that this was a pretty rapid expansion back into the zone. And what we can see is when we continue down, we also had this supply zone, this range created supply or pivot supply that we've been able to refine to one candle. When we look at the return to that, we have a V return, and what we can see is price just blows right through it. Leading into that zone, we had this range created demand, which we've been able to refine to a pivot created demand, as well as this range created demand that, again, we've refined to pivot created demand. If we look at the return to this zone, we had a fairly aggressive V-shaped return. And as we can see, that this is basically just one large move to the downside. And as well as this demand zone, we can see that this was an aggressive V-shaped return. We did get an initial reaction, but again, we just moved to the downside as a result of that. So we move on to the next supply zone. We can see that this supply zone that was created, we had a V-shaped return back to that supply zone, as well as this supply zone was more of a V-shaped return as well. A little bit more interesting since we had the range created demand that happened just before it really tapped into it, because as we can see, we had a reaction to the supply zone, but then price continued on to the upside. So on a lower time frame, this may have been a setup, and this is why you can identify reactions to supply and demand zones. But if we look at the reaction that really happened, we ended up moving more aggressively to the upside rather than the downside. So from that, conceptually, not a strong zone. Then we'll carry on to this zone, which we can very clearly see just looking at it. We had a very aggressive move back into the zone, a V return. And we'll just keep moving to the right side of the chart. This is an interesting one right here. As we had initially mentioned that this was a range created supply zone that we were able to refine to more of a pivot created supply zone. As we came down, we can see more fractally, we had a pivot here, and that's what we drew our supply zone based on. And what we can see is price sort of moved aggressively away initially, and then we started to consolidate. We created this range. And not going too much into session times, but this does fall within a lower volume sort of period. This would be the Asian session. So a lot less volume. And again, this goes back to what ranges imply: high momentum, fair value, lots of orders changing hands, or low volume. And what we can see is, yes, in this case, we did get a decent move out. We can argue that these are some larger candles coming out pre-London session and at the London Open. But the follow through wasn't exactly ideal, but I'm getting ahead of myself when I touch on some of those topics. But just to explain this a little further on, we had a range, this corrective departure from the zone, and then it ended up being more of a V return. And what we can see from here is obviously we did get a pretty solid reaction, but then again, when we look, we didn't actually tap into the zone. And then we'll just look at these last few zones here. What we can see is we had this pivot supply. And if we just look at the way price returned back to the zone, it was a V return, because we're looking more specifically at the return, not so much the dismount away. And really when it comes to the dismount, we do want to see something more aggressive rather than something that's a little bit more corrective as well, because when we're looking at supply and demand zones, while we do want to see a corrective move in, we don't necessarily want to see a corrective move out, because what we are trying to do, again, with supply and demand is we're trying to identify areas on the chart or the footprints of where large orders are being placed in the markets that's causing a displacement in the market. And that's why moves or large moves are happening. And as a result, we're looking for price to return to these areas to rebalance those orders, essentially re-injecting the majority or the remainder of the positions that were created or entered on the first creation of that zone. Because essentially what we're trying to do with supply and demand is we're identifying a footprint of where large orders have been placed in the markets. We know that when institutions are entering large orders, generally speaking, they're not able to put their entire position size within their orders, so they're banking on price to return back to the zone in order to enter the remainder of their position, and that's where we're looking to target. But the only way for us to truly know if an institution or large collection of orders have been placed is by understanding and identifying the footprints that are left behind. Generally speaking, what that entails is seeing some sort of range or pivot created supply or demand zone that is being created. But the only way we're able to validate that zone being created is actually waiting for an impulsive move or an expansion outside of that pivot or range that was created. And then, like I had said, we're looking for how price returns to that zone. Generally speaking, we're looking for some sort of corrective nature back into it. We're looking for some sort of rounded move into it, but we're trying to be a little bit more cautious with something that's just pure momentum back into the zone in question. Now, on the flip side, with this idea in mind that we're looking for that expansive or explosive move from a zone being created, and that's what gives us our footprint that large orders have been placed. If we look at something like this that is very corrective going down and then impulsive going up, generally speaking, what that would imply is that there's no real momentum that fueled this move. This would be the momentum that we're more or less interested in. So when we see that, that begins to give us a better idea of what's happening. But of course, the market isn't utopian, and it will do things that might not necessarily make sense on that particular time frame, and it's all about the higher time frame narrative as to what's happening. And as we can see, if we just zoom out that little bit, we were in a bull trend. We came down very corrective to a demand zone. We did get that initial reaction. But then as we can see what's happening in here, the flip between supply and demand is what's ultimately starting to push price to the downside. And we can see that when we start to look at supply zones that are being created on the way down, and also not holding any other demand zones that have been created as a result of the way price action has been delivering. So again, the best thing that you can do now that you understand the return to zone considerations and the probability that they have, and just looking at things through that lens, is to go to your charts, whether it be a blank chart or whether it's the examples that you've been able to prepare as a result of the first and second parts of the supply and demand zone series, and identify the returns back to the particular supply and demand zones and what they imply on the charts. We're going to build on this much further. These concepts of return to zone are going to be a lot more prevalent and understanding once we start to understand the reaction, the inner workings of supply and demand, and what one zone respecting or breaking another has with the overall larger picture. But first, it's a good idea to really ingrain the understanding of how price is returning back to particular zones and what that implies, as well as, again, understanding the larger impulses into the moves and what that often will provide to you as well. And again, I just want to stress that the market isn't utopian, and don't take some of this for gospel. Go ahead and test it for yourself and see if these sort of concepts are true to what you see, because there are some people who actually prefer trading V reversals, but they're a little bit more aggressive in how they do it. Again, there's different confluences you can add to it, and it comes to your testing and your comfort with them. And which is why it's so important to take these concepts to the charts and really dig into the price action. Because for me personally, when I'm looking at supply and demand zones and how price returns to them, I prefer the rounded returns and the corrective returns as opposed to the V returns. I've had more losses on aggressive V returns than I have on the corrective returns. But again, that also comes to your own testing, and it's important to really put the work in to understand how all these components come into play, because what you'll also start to begin to notice when you combine all of the three lessons into one is the zone creation, the different ways that you're mapping, whether it's range created or pivot created supply and demand, whether it's a continuation or a reversal pattern, will also play into the fact on how price is returning to these zones. Because like we said, this was a continuation pattern. We had a V reversal return, the zone didn't hold. We had a continuation pattern, we had a V reversal return, the zone didn't hold. Continuation pattern, V reversal return, the zone didn't hold. So we can see when we add on to the fact of continuation versus reversal models, we see a reversal model and we see a more corrective return back in, and we see the price get respected. Although in this case, when we look a little bit further, we have a continuation model, but we have a corrective return in, and we do get an initial reaction to it. But again, that's the importance of really understanding these concepts on a granular level. And that's why it's so important to initially put the work into understanding how to visualize the mapping techniques, whether it's range or pivot created supply and demand, then build on that understanding so that you understand the continuation versus the reversal models. Now it's important to apply how price is returning to how the zones are mapped and what the implications may imply, as well as whether they are reversal or continuation models, how price returns to them. And taking it a step further, if the reversal or continuation models are using a specific mapping technique, how is price returning to them, and how does price respect those particular elements? This is how you start to begin to build your trading models that you personally will use in various situations. You may have certain mapping criteria that you use in certain situations. You might only use pivot created supply and demand on continuations. You might only use range created supply and demand on reversals. You might use both, but then how price returns to each one of those dictates what you're looking for. You might look for more confirmation if you get a V reversal to a continuation model. You're looking for an additional entry confirmation that we'll get into in a later video portion. But again, just to get your mind thinking. But first, it's important to now take what we've been able to apply here, these return to zone considerations, and apply them to your charts so that you can understand them and continue building on what we've built in episode 1, 2, and now 3.